Hi folks, this is your accountant Mansoor Sohail. I operate out of Toronto, Ontario, and my specializations are taxes for Canada and USA. My presentation today is for educational purposes only. It does not constitute any legal advice or opinion, so please do not use any of its contents without seeking a professional advice. I will be talking about international tax transactions, USA. What are the issues in it? So first issue is jurisdiction issues. Jurisdiction issues are like who is to tax, who to tax, what income should be taxed. So one way of determining tax jurisdiction is based on personal relationship between the taxpayer and the country. Another way of determining tax jurisdiction is based on economic relationship between the taxpayer and the country. If a taxpayer lives in one country and draws income from another country, double taxation issues may arise. Home country will usually resolve this double taxation issue either by allowing to exclude foreign source income or by taxing foreign source income but allowing a credit for any foreign taxes that are paid. The United States tax system allows foreign tax credit. US residents, citizens, resident alien individuals, and domestic corporations are taxed on their worldwide income. An alien who meets the green card test or substantial present test is considered a US resident. A US person can claim a credit for the foreign income taxes imposed on foreign source income. Foreign source income earned by a US person through a foreign corporation is not taxed by the United States until it is repatriated to the United States. US citizens or residents who live and work abroad may qualify to exclude limited amount of foreign earned income and housing costs amount from their US taxation. If foreign persons earn income in the United States through a trade or business, taxes. They are subject to taxes on graduated rate. If a foreign person has income from the United States, it is subject to flat tax rate of 30%. Income tax treaties usually reduce the withholding tax rate on interest, dividend, and royalty income to 15% or less. Capital gains from sale of stocks, bonds, and other securities are generally exempt from US taxation. However, gains from the sale of US real estate property are subject to different rules. Source of income rules. Interest income is US source if the peer is a domestic corporation of a US resident, and it is foreign source if the peer is a foreign corporation or non-resident. Dividend income is US source if the peer is a domestic corporation and foreign source if the peer is a foreign corporation. Personal service income is US source if the services are performed in the United States and foreign source if the services are performed outside of the United States. Rental and royalty income is US source if the property is used in the United States and foreign source if the property is used abroad. A gain on the sale of a US real property interest is US source income, whereas a gain on the sale of real property located outside of the United States is foreign source income. Gross income from the sale of inventory that the taxpayer purchased for resale is sourced based on where the sale occurs. The place of sale is determined where the title of the goods passes from seller to buyer. currency exchange gains or losses, insurance underwriting business, international communications income, space and ocean activities income, and transportation income are subject to special source of income rules. Folks, all this information comes from the book U.S. Taxation of International Transactions, ninth edition, written by Robert J. Massey Jr. and Michael Shadewald. Publishers are Walter Kluwer, CCH Incorporated. Thank you.